Hey, what's up, everyone? This is Tom from Wall Street Value. Hope all of you guys are having a great day so far. In today's video, I want to share with you one of my most favorite trading strategies, and it's called the Iron Condor. One of the great things about options trading is that it allows you to make money in any market direction. If it goes up, if the market's going down, or in this case, if the market trades flat. Our long-term wealth will be made investing in great, fundamentally sound long-term stocks. Value investing. It's Warren Buffett's style of investing. But if you're only investing with a strategy that makes money if the market's going up, then you're leaving a lot of money on the table. So this is why I think this strategy right here is very important, because this is a way to make money if the market is in a flat trading range or the security that you're trading is in a flat trading range. A couple of great things that I love about the Iron Condor is we can set this trade to where we have a probability of success of 90% or better. So the odds of us having a winning investment are greatly increased. We can have consistent winners over and over and over again. Another thing I love about the Iron Condor, it gives us passive income. So when we place a trade that represents our maximum profit right off the bat, and as long as the trade stays within a certain range, we make that maximum profit. And that income goes into your account the very next day. And unlike some other options trading strategies, this one has a lower margin requirement. I'll explain that in the video. So I hope you guys like it. Stick around, and after this video is done, let me know if you have any questions or if there's anything else you guys want to hear about in upcoming videos. So what I'm going to share with you right now is a video from one of our live training classes. So I hope you guys like it. I'll see you at the end of the video. When we buy stocks, we're doing so with the expectation that the security will rise in price. However, there are times when the market or the individual security that we're investing in just isn't moving up. This could occur because the company that we're investing in is currently out of favor, the industry that it's in is currently out of favor, or the market as a whole is out of favor. Eventually, it will rebound, and we just need to be patient and wait for that to happen. But when we're trading, we can make a profit even if the market is not moving in an upwards direction. As you know by now, we can profit in any direction as an options trader. And because of this fact, we can do any type of trade. We can do a bullish trade if the market is trending up. We can do a bearish trade if the market is trending down, and we can do a neutral trade if the market is trading flat. Therefore, we are going to trade the market we are given, not necessarily the one that we want. So far, we've gone over two types of trading strategies that will generate a net credit for us and allow us to profit in a bull market by using the bull put spread, as well as profiting from a down market by using the bear call spread. Today, we're going to give you a trading strategy when we expect the market to be in a flat trading range, which is also known as a neutral market. This is also known as a credit spread because the premiums that we're collecting will be higher than what we're paying for the long positions. Let's get into the specifics of this trade, which is the Iron Condor. And again, we're not your advisors. We're not here to give you specific investment advice or recommendations. We are here to teach you. So anything that we do talk about today should be taken as educational and illustrative purposes only. If you now understand how the bull put spread and the bear call spread trades work, then you will understand this very easily because the Iron Condor, also known as the Condor, is simply a trade where we simultaneously place a bull put spread and a bear call spread at the same time on the same security with the same expiration date. This spread shares the following characteristics. It's a vertical spread because it's constructed using the same security and the same expiration date. It's also a credit spread because the premiums that we're collecting from the short positions will be higher than what we're paying for the long positions. It's a combination of the bull put and the bear call. Well, how's that possible? How can we do both a call spread and a put spread? Doesn't that defeat the purpose? Why would we want the market to go up and down? Or do we? With this trade, we want the market to trade within a range and not go above or below that range. When the market is flat, premiums are low because volatility is low. It's hard to make money. Stocks aren't going up or down, and since stocks are not moving, debit trades are not worth doing. Also, premiums collected on credit spreads are low. But if we can collect twice the premiums in a low volatile environment, that will allow us to make good money when most investors and most traders are not making any money. This trade allows us to do that. When are we going to trade an Iron Condor? We are going to trade this if we are neutral on the underlying security. It also has much lower margin requirements compared to naked selling and also compared to doing just a bull put spread or a bear call spread. Why is that? The market can go up or down, but not both directions at the same time. Therefore, you only have margin requirements on just one of the two spreads, since only one side of that trade can go bad. And you collect two premiums on the margin trade, so the profit potential is higher. We profit if the market goes up, down, or sideways. We're also going to trade this for monthly income because this is a credit spread. And since we're placing two credit spreads at the same time, we're collecting twice the income. It's also great because you have a very high probability of success with this trade. And just like what we taught you with the bull put and the bear call spread, we want to place the trades when we have a 90% probability of winning or better. Another advantage, less day-to-day monitoring, especially when compared to day trading. When you're a stock day trader, you're watching the stock screen all day, every day. We don't need to do that when trading an Iron Condor, a bull put spread, or a bear call spread. We're far away from where the current underlying stock price is. Therefore, just a little bit of monitoring is all that's required. And again, as long as you apply our trading rules, it does have limited risk. You only have margin requirements on one leg of the trade, either the bull put spread or the bear call spread. A leg is referred to as one side of the trade. It is impossible to lose on both sides. The stock market, the stock, whatever it is you're trading, can't go up and down at the same time. So that's why you only need to have margin requirements on just one side of the trade. Assume for a moment that we're going to place a bull put spread. We're going to collect $1 for the $40 puts, and we're paying 50 cents for the $30 puts. We're going to collect 50 cents for that transaction. And for the bear call spread, we're going to collect $1 for the $60 calls, and we're going to collect 50 cents for the $70 calls. We're also collecting 50 cents. Our total net credit for this trade is $1. Since we only have margin requirements on one leg of this trade, but we are collecting two premiums, our total money at risk and margin requirements are going to be lower. So the total money at risk equals the spread, in this example is $10, minus the premiums collected, which is $1, and we're going to multiply that by 100. So our maximum risk here is $9 times 100 shares. This trade is going to give you a max risk and a margin requirement of just $900. It sounds great so far, and this trade really is, otherwise I wouldn't be teaching it to you. But there's no such thing as a perfect trade. Here are the drawbacks of the Iron Condor. You do have high potential losses. And just like the bull put spread and the bear call spread, the initial premium represents our maximum profit. We're risking $900 to just make $100. And that limited profit potential exists. The most that we can make on this, in this example, is $100. Also, you have higher commissions. Online brokers have really dropped their commission fees over the years to a point where the cost per trade really isn't even much of a factor. However, you do need to consider the cost of placing a condor, especially if you're going to be doing this one contract at a time if you do have a smaller portfolio. The condor consists of 4 transactions. We're going to be selling a put, buying a put, selling a call, and buying a call. So technically speaking, that's 4 trades, and 4 trades means there's 4 commissions. So please be aware of the cost to do this trade before placing the trade. And also shop around for the best broker to fit your needs, especially if you think this is going to be a trade that you're going to do on a regular basis. Many brokers offer incentives to go with their platform. So try to negotiate a lower cost or a number of free trades to start out. When I first opened my account at Schwab, they knew I was a pretty active trader at TD Ameritrade. So they offered me 500 free trades to go with them. So try to do the same thing. I mentioned this already, but it's important, so I'll say it again. This is when we are going to consider placing this trade. If we are neutral, we only do this when our outlook is neutral. We think the stock's going to trade flat. We do not want the underlying security to move around much. We're also going to do this because we want to profit in 3 directions. If the stock goes up, we can still make a profit. Ideally, if it stays flat, that's the best situation, and we make a profit. And if it goes down, we can make a profit. But with this trade, we just don't want to go too far up or too far down. It's also great for immediate income since we're placing 2 credit spreads, we're collecting twice the income. It's also good if you have limited funds, and also if you apply the trading rules, you will have minimum losses. When are we not going to place an Iron Condor? If we think that the underlying security is poised to have a spike up in the near term, we're not going to do it. Or if you think it's going to have a sudden drop in the short term, we're not going to do this. And again, just like the bear call spread and the bull put spread, we're not going to trade this during earnings. This does not apply if we're trading an index. Here's a Condor example. Assume we wanted to trade XYZ and the current price is still $50 a share. Over all the sections that we've covered, it hasn't moved. It's still at 50. And we're going to continue using this as an example. We would place a bull put spread by selling a $40 put and buying a $30 put with a net credit of 50 cents. We would place a bear call spread selling a $60 call and buying a $70 call and collecting 50 cents. By the way, you can select any spread that you want. I keep using these 10-point spreads as an example, but you can do a 5-point spread, a $2.50 spread. You can also do a $1 spread if you wanted to. Here's how this trade would look. As long as the underlying security stays within this range, $40 to $60, you will end up with a profitable trade. As long as it stays within this range, we're good. If it comes up a little bit, we'll have a limited profit, but still a profit. And then obviously if it goes beyond the long call or below the long put, we're going to have a loser. And you could still have a winner if the underlying moves slightly past either one of the short strike prices, as you can see right here with the break-even points. But as you'll learn in a moment, that is getting into dangerous territory. We are going to close out our trade early if the trade gets too close to loser territory. Since the spread that we're looking at is a 10-point spread, and we're collecting an even amount for both trades, 50 cents, individually, they have an at-risk amount of $10 minus 50 cents or $9.50 per trade, and that is a rate of return of 5.26%. If you were to combine these two spreads into an Iron Condor, the math changes, and it changes for the better. Now you have $1 in total credits, and since only the bullish or bearish side could possibly go bad, here's how the math looks. We're taking in $1, 50 cents for the bull put, and 50 cents for the bear call spread. Amount at risk is $10, minus a buck we're collecting, so now our total at risk is just $9 for this trade. And our rate of return is 1 divided by 9, or an 11.1% rate of return. Combining the two trades and having just one margin requirement compounds your rate of returns exponentially. Your credits increase, your max risk is decreased, and your rate of return is going to be much larger. My trading rules for the Condor are just about identical to the bull put spread and the bear call spread. We want to make sure the probability of expiring out of the money is 90% or higher. The delta must be 10 or lower with a short strike price. We want to make sure we're making 3% on each side of the trade. This trade is going to be 28 to 48 days until expiration. And preferably, we're going to do this trade on an index such as the Russell 2000 or the S&P 500. If you trade in individual security, do not do this during earnings. When we're trading the Iron Condor, it's our hope that the underlying index or the security remains in a relatively narrow trading range from the time that we open the position until the options expire. If the underlying does not get close to either of the strike prices, you may keep the position open until expiration and then let all 4 options expire worthless. And since you don't need to close out the trade, you don't have to pay any commissions to close out early. At expiration, if all the options are out of the money, they expire worthless, then you got to keep the entirety of both premiums that you collected when initiating the Iron Condor, minus commissions to place a trade. However, if the trade starts to go against us, we need to utilize some asset management practices so we don't get hurt. Holding on to a losing position through expiration is dumb, and it goes against our trading rules. Therefore, we're going to manage the position. One thing we can do is just close out the position early. If the underlying security has yet to reach either short strike prices, we can still make a profit. If the underlying security goes past the short strike price, past the break-even point, but not through the long strike price, we will have a small, manageable loss. However, we're not going to wait for that to happen. We want to close out early if the underlying security gets close to either one of the short strike prices. Once you get to the week of expiration, you may want to close out of the position early and keep most, but not all the premiums that you collected. This is a risk management strategy to employ if the current underlying price is starting to get close to either of the short strike prices. And we do this the week of expiration because at that point, time decay has really worked in our favor and allowing us to capture just about all the premium that we originally collected. As the saying goes, nobody ever went broke taking a profit. Here's some of my trading rules for closing out of the trade early if things do not go our way. First off, we are going to get out if the underlying price ever hits the short strike price. Do not hope that it moves away from the short strike price. To avoid this from happening, we're going to get out when the probability OTM is at 70. We're going to get out when the underlying security is 3% from either strike price the week of expiration. We're going to get out if delta hits 22. If the underlying security starts to have a rise in implied volatility within 7 days until expiration, we are also going to close out the trade. And another idea is to place a stop loss once a trade has a loss that you are able to accept. For most traders, that can be anywhere from 20 to 30%. Stick to the rules, even if you have a loser or two. The rules are time tested. Do not veer away from these. If you stick to it, you will have a lot of success with this trade. I mentioned that time decay works in our favor for this trade. I went over briefly a few times already in this course, but I'm going to cover it again right here, just real briefly. Time decay is a ratio of the change in an option's price to the decrease in time to expiration. Since options are wasting assets, their values decline over time, and it declines very rapidly the closer it gets to expiration. This has more of an impact on long options. A wasting asset is any asset that has a limited lifespan, and all options have limited lifespans. They're called expirations. This leads to the value of the asset to decrease over time due to the fact that the outcome is more likely to be known closer to expiration date. This is especially true of options that are out of the money, since as it gets closer to expiration, the option becomes less and less likely to become in the money. As option approaches its expiration date without being in the money, its time value declines rapidly because the probability of that option being profitable in the money for long options is greatly reduced, as we can see right here in this chart. Time decay hurts option buyers, but it helps option sellers. And that's who we are when we're placing any type of credit transaction. You can see here that time decay doesn't really do anything for us the longer we are from expiration, but as we get closer to expiration, option prices diminish rapidly, which works in our favor. Therefore, if we want time decay to be in our corner, then the sweet spot for selling a condor is slightly over 30 days. That's because there's enough time for us to get paid a decent premium, but not too much time where time decay doesn't yet start working for us. This is why I absolutely love selling options, not buying options. I know I sound like a broken record because I've said it so many times already, but I'm going to say it one more time. As a buyer of options, you must accurately predict the direction in which that security will move, and you need to accurately predict the amount of time it will take to make that move. If you don't pick enough time, you could have a complete loser. If you pick too much time, you're paying for that extra time, and if you are right in the direction it went, your profits diminish because you paid too much for extra time. I'm not smart enough to ever be able to determine the direction and the correct time frame, let alone do it often enough to be consistently profitable. That's a loser's game. I don't like losing. As Mike Singletary said, I want winners. As a seller of options, we just need to place a trade in any direction that we think the security will not go. It's a lot easier to do that. We don't have to be right in the time or the direction. We just can't be too wrong. As time ticks away, that benefits us as the option seller. Time decay works for us, not against us as sellers of options. In the previous two sections, we used 4 trading indicators to help us determine a short-term trend on any security that we're thinking about trading. We use the Williams percent R, the moving average, stochastics, and the MACD. By now, you should be very clear on how they work and how to identify a current trend. With this trade, since we're looking for the underlying security to be neutral, we do not want to see the arrows turning positive at the same time or turning negative at the same time. Now we want the indicators to stay in the middle of the overbought, oversold levels. As you can see in this chart, right in between the highlighted lines, this stock didn't have any arrows, positive or negative, for about 2.5 months. This is a perfect example of a stock that was prime trading for the Iron Condor. Let's see if we should trade the Russell 2000 index, which tracks 2,000 small-sized companies. And the symbol here is RUT. As you can see here, the index is in an obvious uptrend. As you now know, we need this to be range-bound for the Condor to make sense. The way this chart looks, it seems like a bull-put spread may make more sense. Obviously, we're not going to place a Condor here because the way the chart looks, it is in an obvious uptrend. We clearly see higher lows, an all-time high close yesterday, and obviously it's not in a neutral trend. Now let's take a look at the S&P 500 to see if this makes sense. This is definitely in a well-defined range. It's not breaking through the downside or the upside, at least not yet. I would have to wait a few days to make sure it's going to bounce off or break through the ceiling right here. Here are the setups for the put side of the trade. This is the bull put spread. If we look up here, this is the current price of the S&P 500 index. We're selecting a 36-day trade. If we come over here, we see that the probability OTM is 92 and the delta is less than 10. The short put is going to be at 25.70 and we are collecting $4.70. And the long put's at 25.60. So again, this is going to be a 10-point spread and we're paying $4.40. So we're collecting 30 cents for this transaction. And here's the call side of the trade. This is the bear call spread. So we come over here to the probability OTM, and we're well in our range. It's at 95%. The delta is at 5, so this is looking pretty perfect so far. We are selling the 29.20s and collecting $1.52, and we are buying the 29.30s, and we're paying $1.25. Do we trade the S&P 500? Well, it's almost at a resistance level, so we have to wait and see. We need to give it 1 or 2 trading days for confirmation that it did bounce off of it and started to go down. And as long as it does that, I think this is a pretty good trade. The put spread can actually be closer to 85% probability since it is not in a downward trend. The call spread should be in the mid-90s OTM because of the short-term trends. What I like to do is draw lines on the charts for a visual of where the current price is compared to the 2 short strike prices. This will help you keep an eye on how the trade is looking once you're in a position. You literally do not need to spend more than 30 seconds a day monitoring this trade as long as things are going your way. If we decide to place a trade now, here's how the setup will look. The current price is $27.91 for the S&P 500 index. We're going to sell a short put at $25.70. We're going to buy the long put at $25.60. The short call is going to be at $29.20. And the long call is going to be at $29.30. Our net credit is 57 cents. The total money at risk is $9.43, and our total return is 6% in 36 days. That annualizes out to 61.18%. So 6% in 1 month, not bad. So that's it for the Iron Condor. Here's your learning activity for this section. I hope you're now comfortable placing the bull put and the bear call spread. Now I want you to add them together in your paper trading account to form the Iron Condor. Next, I want you to contact your online broker. Call them or email them. That's because the Condor is made up of 4 trades, which equals 4 commissions. Find out what the rates are for your broker and see if they can give you an incentive for opening an account with them. Also, call the other online brokers just to shop around. Some of the more well-known firms that specialize in options trading are TD Ameritrade, Schwab, TradeStation, Interactive Brokers, E-Trade, and Ally Invest. If you have any questions understanding this trade, placing the trade, or anything else, please make sure you hop on the live Q&As. So I hope you enjoyed this section, and I'll see you over in section 8. Take care, everyone. I hope you like this video. If you do, please hit the subscribe button below and make sure you turn on notifications so you don't miss any of our upcoming videos. Also, please comment below and let us know if you have any questions with this stock market stuff, and I'll do my best to answer any questions that you may have. And let us know what specific topics you'd like to learn more about. Because I created this channel for you guys to educate you, so please let me know what topics that you're interested in, and I'll create some upcoming videos around the content that you want to hear about. And if you want to learn more about value investing or options trading or anything related to investing in the stock market, we do have a few different ways to give you the content that you want. We offer a few online courses if you want to learn about investing at your own pace. We have live online group classes. We do a live weekly trade room where we analyze investment opportunities together. And I also offer one-on-one coaching for those of you who want a more personal learning experience tailored just for you. So check out the links below this video. This first one is a link to schedule a call with me. So if you don't know which route is best for you, or if you just have some questions before taking the next step, click the first link to schedule a call with me. And the second one takes you to a live training video where I show you my top 3 secrets to investing in the stock market. I share with you the types of stocks that I look for personally, how I value those stocks, and the #1 resource that I use to find investing opportunities that you can act on right now. Hope you guys like it, and hope to see all of you guys in the next video. Take care, everyone.